Welcome to Tesla Daily News Podcast for Saturday, March 7th, 2026. Today, we're tracking a key shift in Tesla's Europe economics, a meaningful inflection in European demand signals, a notable chip supply headline tied to Tesla's next-gen compute, and why BYD's latest charging push matters for Tesla's moat and margins. Let's get into it. Story 1. Tesla's EU emissions credit money machine is cooling off. Here's the hook. Two of Tesla's biggest emissions pooling customers in Europe are reportedly walking away. Context. In the European Union, automakers must meet fleet carbon dioxide targets. If they can't, they can either pay penalties or join pools with cleaner fleets. Tesla has historically monetized its zero-emission status by effectively selling compliance to other manufacturers. Investors like this revenue stream because it tends to be high margin. Details. Multiple European reports say Toyota and Stellantis are exiting their emissions pool arrangement with Tesla for 2026 because they can now meet their targets without buying Tesla's pooled credits. The key point is not the paperwork, it's the profit mix. This is the kind of revenue that can quietly support automotive gross margin when vehicle pricing is under pressure. Impact. If this trend broadens, Tesla could face a headwind to regulatory credit revenue in Europe over the next 12 to 24 months. The market usually values recurring, high-margin revenue streams highly, so any sign that credits are normalizing lower can weigh on sentiment, especially if investors are already focused on vehicle margin compression. Takeaway. Watch Tesla's next earnings commentary for any change in expectations around regulatory credits. Also watch whether other automakers follow Toyota and Stellantis out of pooling as their own EV mixes rise. Story 2. Tesla's Europe registrations turned positive year-over-year, but the comparison is doing a lot of the work. The hook. Tesla posted its first meaningful year-over-year growth in Europe in more than a year, but it's coming off a depressed base. Context. Europe has been a pressure point for Tesla, with intensifying competition, price-sensitive consumers, and a wave of new EV models. Registrations are not perfect, but they're one of the cleanest near real-time demand indicators investors track between quarterly delivery reports. Details. Electrek reports Tesla registered 17,425 vehicles across 15 major European markets in February 2026, up 10% versus February 2025. Impact. A positive year-over-year print can stabilize the narrative that Tesla demand in Europe is in freefall. That matters for multiples because the market typically punishes Tesla most when it believes the growth story is structurally broken. But the caution flag is the base effect. If the prior year month was weak, you can get a positive percentage number without truly robust momentum. Takeaway. Treat this as a stabilization signal, not a full rebound. The next 2 months matter more than the headline. If March and April also show consistent year-over-year growth, analysts will be more willing to model steadier European volumes. Story 3. The UK looks like a Tesla soft spot right now. The hook. Tesla sales in the UK reportedly fell sharply in February while BYD surged. Context. The UK is a visible, competitive market where consumers cross-shop aggressively and where pricing, incentives, and product freshness can swing share quickly. It's also a market where brand narrative can matter. Details. A Reuters-cited report relayed by Lenta says Tesla's February 2026 UK sales were down 37% year-over-year. The same piece says BYD climbed, with BYD deliveries in that market rising strongly year-over-year. Impact. A steep UK decline can feed investor concern that Tesla's European performance is uneven and that competitive pressure from Chinese brands is no longer just a China-only issue. If Tesla has to respond with additional pricing or incentives, that's a direct margin question. And in this tape, margin questions move the stock faster than unit questions. Takeaway. Keep an eye on Tesla's regional pricing actions in Europe and whether Tesla uses financing deals rather than headline sticker cuts. Financing support can protect ASP optics, even if it still costs money. Story 4. Tesla's Supercharger build-out in Spain just hit a round number milestone. The hook. Tesla crossed 1,000 Supercharger charge points in Spain, and most are high-power. Context. Charging availability remains a gating factor for EV adoption, especially for buyers who don't have home charging. Tesla's network is both a demand enabler and, increasingly, a potential services revenue lever. Details. Europa Press reports Tesla reached 1,000 superchargers in Spain across 96 stations and says 91% of those charge points offer 250 kilowatts of power, enabling up to roughly 275 kilometers of range added in 15 minutes. Impact. Near term, more charging coverage supports Tesla's sales funnel and can reduce purchase friction, which matters most in competitive regions. Medium term, a dense network can strengthen Tesla's negotiating position as charging standards and roaming agreements expand. Takeaway. Investors should watch not just charger count, but utilization. High utilization can turn infrastructure into a meaningful cash flow contributor, while low utilization is mostly a strategic moat play. Story 5. Tesla software terminology shift in driver assistance is a subtle, but important risk management move. The hook. Tesla is reportedly removing the Autopilot name from parts of its software interface in a new update. Context. Tesla's driver assistance branding has long drawn regulatory and legal scrutiny. Even if the underlying functionality does not change, language changes can reduce misunderstanding risk and potentially soften regulatory pressure. Details. Webnews.it reports Tesla is removing the Autopilot definition from its software naming with update version 2026.2.9, changing terminology around driver assistance features. Impact. This is not a revenue catalyst by itself, but it can reduce tail risk. For Tesla investors, tail risks include regulatory restrictions, forced feature limitations, or brand damage from misuse narratives. Takeaway. Track whether this naming shift coincides with any changes in feature packaging, pricing, or the path to supervised autonomy approvals in more jurisdictions. Story 6. Tesla is said to be ramping orders for its next-generation AI chip, and Samsung's Texas plant is a key beneficiary. The hook. A report says Tesla plans to double AI6 chip orders, boosting Samsung's foundry utilization in Texas. Context. For Tesla, custom silicon is about cost, performance, and supply control. If Tesla can secure large volumes of inference and autonomy-related compute at the right price, it supports margins and improves deployment speed for autonomy features and robotics. Details. DG Times reports Tesla is expected to double orders for its AI6 chip, which would help utilization at Samsung's Taylor, Texas facility. While the report doesn't specify exact unit counts in the snippet we have, the core investor signal is that Tesla appears to be planning significant compute capacity. Impact. If accurate, this supports the bull case that Tesla is preparing for higher volumes of autonomy compute rollout, potentially tied to full self-driving expansion, robotaxi pilots, or Optimus-related manufacturing compute needs. Markets tend to reward credible capex and supply chain signals when they align with a clear monetization path. Takeaway. Watch for corroboration from Samsung Foundry commentary, and watch Tesla for any timeline details about AI6 deployment. Silicon ramps matter only if they translate into shipped products and paid features. Bonus competitive check. BYD's 5-minute charging push raises the bar, but infrastructure is the catch. The hook. BYD unveiled ultra-fast flash charging and new battery claims that compress charging times dramatically. Context. The fastest-moving competitive battleground right now is not just vehicle range, it's charging time and charging convenience. If a competitor can make charging feel like fueling, that can pressure Tesla's perceived advantage, especially in markets where superchargers are not the dominant network. Details. TechCrunch reports BYD says its Blade Battery 2.0 can charge from 10% to 70% in 5 minutes, with close to full in about 4 minutes more, but notes there's a catch. You need extremely high-power chargers. And that requires heavy infrastructure build-out. Electrek separately highlights BYD's 1,500 kilowatt charger concept, far above common deployments in the US. Impact. For Tesla, the implication is two-sided. 1. It raises consumer expectations, which can shift purchase decisions if Tesla can't match the experience broadly. 2. It highlights Tesla's strategic asset. Tesla already operates a scaled fast-charging network. If the market shifts toward very high peak power, network capex and grid constraints become a larger part of the competitive equation. Takeaway. Tesla investors should watch whether Tesla responds with higher power supercharger deployments, improved preconditioning, or battery chemistry tweaks that increase real-world charging curves, not just peak numbers. Now a quick market note to close. Tesla shares were reported by One Market Summary as down about 0.14% in Thursday trading, closing around $405.55 after a prior day bounce. That's it for today. Recap. The biggest themes are a potential headwind from shrinking EU emissions credit pooling, early signs of Europe stabilization with pockets of weakness like the UK, continued supercharger expansion in Spain, a driver assistance naming shift that could reduce regulatory tail risk, and a reported AI chip order ramp that hints at bigger autonomy and robotics ambitions. For tomorrow, watch for any additional Europe registration data, pricing moves, and any follow-up reporting on Tesla's AI6 chip supply chain and deployment timeline. If you want this every day, subscribe to Tesla Daily News Podcast and follow us for your daily, investor-focused Tesla Roundup.